Welcome in. It is fantastic to have you with us today for this deep dive.
Yeah, we are really excited to get into this one.
Definitely. If you're tuning in right now, you are probably a lot like us. You're intensely curious. You keep a close eye on the horizon for the next monumental technological shift. And you're probably entirely exhausted by the impenetrable financial jargon and advanced physics equations that usually surround this topic.
Right, because it gets overwhelming incredibly fast.
Exactly. You want to understand the explosive, highly lucrative world of quantum computing stocks and ETFs. You want to know exactly where the smart money is moving in 2026, but you really shouldn't need a doctorate in quantum mechanics to figure out your portfolio, so you're in the perfect place.
That is our exact goal today. We are taking you on a comprehensive, incredibly detailed journey through the financial landscape of quantum technology. We're translating all that bleeding-edge science into actionable financial intelligence.
And we have compiled an immense stack of research for this analysis. We are pulling critical data, forward-looking guidance, and market insights from a variety of heavy-hitting sources. We're looking at reports from WTOP News, The Motley Fool, The Quantum Insider, SpinQ, Blue Quibit, and Column Content.
It is a massive amount of intelligence to sift through.
It really is. Our mission today is highly specific, though. We are doing a deep technical analysis of the absolute best quantum computing stocks and ETF to consider right now in 2026.
We are going to review company earnings, their strategic guidance, and what the top Wall Street analysts are actually recommending behind closed doors.
Yeah, and by the end of this conversation, we are handing you the top 5 stocks and the top 3 ETFs based entirely on their performance and their cost.
Okay, let's unpack this. Why are we talking about quantum computing right now? What makes 2026 the critical year?
We are sitting at a staggering inflection point. To really understand why institutional money is flooding into this space right now, you have to look at the growth trajectory.
The market size projections are wild. They are. We are talking about a global market that was valued at roughly $3.5 billion back in 2025. According to the research, that exact same market is projected to skyrocket to up to $198 billion by the year 2040.
That is an astronomical leap. What is the actual catalyst for that kind of projected growth?
It's a fundamental shift in the physical capabilities of the machines. We have been stuck in what the industry calls the NISQ era. That stands for Noisy Intermediate Scale Quantum.
Which basically means the computers technically function, but they're highly error-prone, right?
Exactly. They require gigantic multi-million-dollar sub-zero cooling systems just to operate. But the research indicates we are rapidly crossing the threshold into the quantum advantage phase.
And that is the holy grail.
It is. It's the exact moment where these machines definitively solve real-world, highly complex problems faster and exponentially cheaper than the most powerful classical supercomputers on Earth. The transition between a science experiment and a commercial necessity is happening right now.
Which completely explains why the financial markets are reacting with such extreme volatility and aggression. But before we start naming specific companies, we need a major topic shift. We have to talk about how you, as an investor, should actually evaluate these quantum computing companies.
Right, because traditional metrics don't really apply here.
They don't apply at all. If you go into your brokerage account looking at standard metrics, you are going to get completely lost. But for anyone who needs a quick mental model on the tech itself before we hit the financials, if traditional computing is a coin sitting on a table, it's either heads or tails, right? A 0 or a 1.
Classical bits.
Exactly.
Yeah.
Quantum computing uses qubits. A qubit is that coin spinning in the air. It exists in a state of every possibility all at once. It calculates millions of outcomes simultaneously. And because of that immense shift in physics, the financial math completely changes too.
What's fascinating here is how that paradigm shift completely rewrites the financial evaluation. For pure-play quantum hardware companies, the startups whose entire existence relies on building those spinning coins, traditional earnings metrics like price-to-earnings or PE ratios are currently irrelevant.
They just don't matter yet.
Not at all. There is really only one metric that dictates their survival right now, and that is cash runway.
Cash runway. Let's break that down for the listener in the context of a hardware startup. Why is that the ultimate litmus test?
Because almost all of these pure-play quantum companies are entirely pre-profit. They are bringing in a trickle of revenue, but they are burning through astonishing amounts of capital on research and development.
Yeah, building a highly specialized facility with cryogenic cooling systems that drop temperatures to near absolute zero isn't exactly like renting server space for a software startup.
The capital expenditure is astronomical. So the true measure of safety for these stocks isn't how much profit they made last quarter. It is how much cash they hold in the bank to survive the long, grueling years of development it will take to actually reach commercial scale.
Right, you're evaluating their fuel tank, not their current speed. You want the companies that have enough cash to cross the finish line without running out of gas and going bankrupt. With that baseline established, let's dive into the main event. We've identified the top 5 quantum stocks from our research.
And this list is a compelling blend. It features highly specialized pure-play startups and one enormous tech giant.
It is a very deliberate list. It represents the entirely different architectural approaches these companies are taking to build a functional quantum computer. It is basically a technological horse race at this point.
It really is.
Let's start with stock number 1, IonQ. Ticker symbol is IONQ on the New York Stock Exchange. They're widely considered the trapped ion leader. I know they have the tech, but what is Wall Street actually saying about their financials right now?
Well, their technology relies on trapped ions, which are individual charged atoms suspended in an electromagnetic field that act as the qubits. But financially, they are the clear heavyweight of the pure plays. In Q2, they reported $20.7 million in revenue.
That's solid for a pure play. But remember our rule about cash runway. This is where IonQ absolutely dominates. Following a recent capital raise, they're sitting on a staggering $1.6 billion cash runway.
Which is just phenomenal. That isn't a fuel tank, that is a financial nuclear reactor. They could fund operations for years without needing to borrow a single dime.
But they aren't just hoarding that cash, are they? The sources highlighted a major strategic acquisition.
Correct. They recently utilized $1.8 billion to acquire Skywater Technology. This is a brilliant long-term defensive move because it allows for vertical chip integration.
Let's pause there for a second. Vertical integration sounds great in a boardroom, but what does it actually mean for their bottom line down the road?
It means IonQ isn't just designing the quantum car, they just bought the factory to build the custom engine. Instead of relying on third-party semiconductor manufacturers who might prioritize larger clients, IonQ can now build their own highly specialized quantum networking components and chips entirely in-house.
Which completely shields them from the kind of global supply chain nightmares we saw a few years ago. Control the manufacturing, control your destiny.
Exactly. And the analysts are clearly rewarding this strategy.
They are. Currently, the average price target for IonQ is $70.83. That represents a very healthy 42.44% upside from recent levels. Out of 17 analysts covering the stock, 9 currently rated a buy.
Let's move to stock number 2. D-Wave Quantum, ticker symbol QBTS. They are known as the optimization specialists.
Right. And D-Wave is a remarkable outlier. They completely ignore the standard gate model computing architecture that almost everyone else is obsessing over. Instead, they focus entirely on a process called quantum annealing.
Which is fascinating. But I always hear that quantum computing is 10 years away from being useful. Is annealing doing anything practical today, or is it still strictly theoretical?
Oh, it is highly practical right now. You don't need to grasp the underlying physics, but you absolutely must understand the application. Annealing is custom-built to find the absolute most efficient route or solution among millions of competing variables.
Like logistics.
Exactly. Imagine a global shipping company trying to route 10,000 cargo ships around the world, factoring in weather, fuel costs, port delays, and cargo weight. A classical computer chokes on that math. D-Wave's annealing process can optimize those logistics instantly, potentially saving billions in operational costs. It is also being used right now for complex manufacturing optimization and advanced financial modeling.
So they're actively solving real-world commercial problems today. What do the numbers look like for a company that is already deployed in the field?
They reported $22 million in revenue over the trailing 12 months, which is incredibly solid for a sector still finding its footing. And they have a healthy safety net, holding about $304 million in cash.
But looking at the charts, their stock performance has been wild. D-Wave surged 345% in 2025 alone. Let me play devil's advocate for a second. With a 345% surge, hasn't the ship already sailed for the average investor? Are they completely overvalued at this point?
It's a totally fair question, but analysts really don't seem to think so. They are projecting a 73.8% upside remaining from its recent levels. The logic here is that if logistics and optimization prove to be the very first truly profitable commercial breakthrough for quantum technology, D-Wave is positioned to capture that entire early market.
Right. If you believe in optimization, they are the undeniable frontrunner. All right, let's look at stock number 3, Rigetti Computing. ticker symbol RGTI on the NASDAQ. They are the superconducting innovator.
Rigetti is taking an approach that most closely mirrors traditional silicon computer chips. They build superconducting circuits. And they recently hit an enormous technological milestone. Their brand new 84-qubit Anka-3 system just achieved a 99.5% median 2-qubit gate fidelity.
Okay, gate fidelity. For those of us not building experimental microchips in our garage, what is the practical translation of that metric? Why does the market actually care?
It translates directly to accuracy and reliability. Qubits are notoriously fragile. The slightest change in temperature or electromagnetic interference causes them to lose their quantum state, resulting in a calculation error. Hitting a 99.5% fidelity rate means their system is incredibly stable.
It proves to the scientific community, and more importantly to investors, that their specific superconducting hardware architecture can actually be scaled up without falling apart.
Exactly. And financially, they're pulling in $1.8 million in quarterly revenue. It's relatively small, but they're holding $571 million in cash reserves to keep the lights on. Now, speaking of stock performance, the research shows Rigetti gained an astonishing 700% in 2025.
It sounds like a typo, but it isn't. A 5,700% gain is jaw-dropping, but it provides a crucial insight into how Wall Street treats this sector. Investors aren't valuing these companies based on their current $1.8 million in revenue. They are treating these technological milestones almost exactly like biotech stocks waiting for FDA approvals.
That is a brilliant comparison.
Yeah, when a biotech firm proves their experimental drug cures a disease in trials, the stock goes parabolic, even if they haven't sold a single pill yet. Rigetti proving their 99.5% fidelity was their successful clinical trial. The market heavily rewarded the proof of concept.
And even after that monumental run, 6 out of 9 analysts still rated a buy, with a 12-month price target of $28.67. That implies a 19.64% upside. It's a wild ride, but clearly one with immense momentum. Let's move to stock number 4, Quantum Computing Inc., ticker QUBT. They are the photonics contender.
This approach sounds like pure science fiction. Instead of using trapped ions or massive supercooled circuits, QUBT relies on photonics. They literally use manipulated particles of light to execute computations.
Superconducting chips sound incredibly expensive to maintain. Is using light a cheaper alternative? What is the main advantage here?
The primary advantage is environmental stability. Because they use light, their quantum systems can uniquely operate at standard room temperature, utilizing very low power requirements. They entirely bypass the need for those gigantic, multi-million-dollar sub-zero refrigeration units that competitors require.
Wait, room temperature. If they don't need sub-zero cooling, that sounds like the absolute holy grail of commercial scalability. Why isn't every single company pivoting to photonics right now? Is it too good to be true?
It isn't that it's too good to be true. It is simply much earlier in its developmental life cycle compared to superconducting or trapped ions. And you see that reflected in their financials. They reported a microscopic $260,000 in revenue over the last year. However, they are sitting on a very comfortable $349 million in cash to fund their ongoing research.
So it is essentially a lottery ticket attached to a very compelling scientific thesis.
Yeah.
As might expect, this stock has been highly volatile, but it gained over 1,800% recently. Analysts are incredibly bullish on the long-term potential here, forecasting a massive 184.19% upside with a price target of $31.70. It's the definition of a high-risk, high-reward play.
Now, for stock number 5, we are shifting gears completely. We are talking about Alphabet, the parent company of Google, ticker GOGL, the absolute giant in the room.
If we connect this to the bigger picture, you have to realize why a colossal tech giant is practically mandatory in a well-rounded quantum portfolio.
Right, because as we have just broken down, the pure play startups are incredibly risky. They could fundamentally alter human history, or they could burn through their cash and file for bankruptcy. Tech giants like Alphabet provide an anchor of stability to a portfolio.
They have massive, highly profitable core businesses like search and cloud computing. But they are silently pouring billions into chasing quantum dominance in the background.
And Alphabet is making undeniable strides. Google's quantum AI division just released a new quantum processor called Willow. The sources we looked at emphasize that Willow just successfully completed a calculation in exactly 5 minutes that would take current state-of-the-art supercomputers significantly longer to process. They aren't just theorizing, they are actively demonstrating quantum supremacy.
And unlike the startups, you never have to lose sleep over their cash runway. Alphabet posted a 13.42% year-over-year revenue increase across its entire global business. They possess the limitless capital required to fund quantum research indefinitely, regardless of how long the commercialization phase takes.
And the broader analyst community loves that safety net. Out of 51 analysts covering Alphabet, an overwhelming 45 rated a strong buy. It is your foundational anchor in a deeply turbulent sector.
Here's where it gets really interesting, though. Alphabet is a great safety net, but even with giants in the mix, picking a single winning startup from the four we just discussed feels a bit like throwing darts while blindfolded. Let's talk about mitigating that risk entirely. Let's talk about ETFs.
Exchange-traded funds are arguably the smartest play for the average investor here. Because the quantum industry is so highly volatile and speculative, ETFs offer a strategic mechanism to buy a diversified basket of these companies simultaneously.
Which protects you. If one specific photonic startup fails, but a superconducting firm succeeds, your overall exposure is hedged. You're placing a bet on the inevitable success of the entire sector, rather than gambling on one single company's proprietary technology.
Exactly. We have meticulously reviewed the market data and pulled the top 3 quantum ETFs to consider, evaluating them specifically on their historical performance and their expense ratios. Let's start with ETF number 1, the Defiance Quantum ETF. The ticker is QTUM.
This is undeniably the heavyweight champion of the space. It is by far the most established and robust fund available. It currently holds around 78 different companies. But what makes QTUM so resilient is that it doesn't just hold the companies building the experimental quantum computers. It heavily weights the enablers.
Define enablers in this context.
It is essentially a picks and shovels investment strategy. During a gold rush, you don't invest in the gold miners. You invest in the companies selling the shovels. QTUM holds companies like Micron and Teradyne. Those are the firms that manufacture the advanced cooling systems, the highly specialized cables, and the traditional semiconductor chips that the entire quantum industry absolutely relies on to function.
And the cost is incredibly reasonable for such a niche sector. It carries a highly competitive 0.40% expense ratio. To put that in perspective, you are paying just $4 a year in management fees for every $1,000 you invest.
As for performance, its scale is enormous. It holds between $3.5 and $3.6 billion in assets under management, or AUM. Over the past year, it has delivered returns roughly between 36 and 43.9%, and it is up an astonishing 394% since its inception. It is the big, liquid, highly established option.
But perhaps you already own plenty of traditional tech stocks and want something much more aggressive. That brings us to ETF number 2, the Wisdom Tree Quantum Computing Fund, ticker WQTM. This is the pure play challenger.
This fund is fascinating specifically because of what it refuses to hold. Wisdom Tree intentionally strips out the mega-cap tech giants. You will not find Apple, Microsoft, or NVIDIA dominating the top holdings of this fund.
The underlying philosophy is that you probably already own those giants in your standard 401k or IRA. You don't want redundant overlap. WQTM focuses almost exclusively on the highly volatile, pure quantum startups.
It does cost slightly more to manage, with a 0.45% expense ratio. And you must be aware that it is a dramatically smaller fund, sitting at only $24.3 to $27 million in AUM. It also had a genuinely rocky start. It is actually down 9.67% since its recent inception.
Let me stop you there and play the skeptic again. Why on earth would I want to invest my hard-earned money into a fund that is actively losing nearly 10% of its value?
Because of the unparalleled ceiling it offers. The mega-cap stocks provide safety, but they also act as an anchor on rapid growth. A company the size of Apple doubling its valuation is incredibly difficult. A pure-play quantum startup doubling in value can happen on a single Tuesday, following a positive press release about gate fidelity.
Right. If the pure-play startups take off as predicted over the next decade, this ETF will absolutely skyrocket because it isn't weighed down by the slow, incremental growth of the trillion-dollar tech giants. It is the ultimate high-risk, high-potential reward ETF.
Finally, we have ETF number 3, the iShares U.S. Technology ETF, ticker IYW. This is your safe, incredibly broad, low-cost foundational play.
IYW completely balances its bets. It provides targeted exposure to quantum development, but it aggressively weights the long-standing, universally recognized tech leaders. You are going to be holding heavy, secure positions in NVIDIA, Apple, and Microsoft right alongside the experimental quantum innovators.
It is the cheapest option of the 3, with a rock-bottom 0.38% expense ratio. And its performance is virtually unshakable. It boasts massive scale with $19.3 billion in AUM, and it delivered a very secure, highly respectable 28.8% one-year return.
So speaking directly to you right now, if you are looking at this data and trying to decide how to allocate your capital, you must ask yourself what your true risk tolerance is. Do you want the pure, incredibly volatile, high-ceiling roller coaster of WQTM? Do you want the balanced, industry-enabling, heavyweight approach of QTM? Or do you want the safe, broadly diversified, foundational tech play of IYW?
This raises an important question about realistic timelines. We've spent this entire deep dive discussing monumental stock gains, 5,700% surges, and massive upside targets. But we have a responsibility to remind everyone that investing in quantum computing is unequivocally a marathon, not a sprint.
The research is crystal clear on this. The genuinely world-changing commercial applications, the ones that will revolutionize pharmaceutical drug discovery, instantly optimize global supply chains, and supercharge AI models beyond our current comprehension, those applications are realistically still 5 to 10 years out.
The financial market is aggressively pricing in the expectation of future success today, but the actual sustainable revenue generated from these specific use cases is a much longer-term play.
So what does this all mean? When we aggregate all the earnings reports, the analyst recommendations, and the technological breakthroughs we've discussed today, the core takeaway is clear. The technology is undeniably moving out of the academic realm of pure theory and directly into tangible commercial reality.
We are witnessing real revenues, brilliant strategic acquisitions like IonQ buying a semiconductor factory, and critical technological milestones being achieved. And the immense cash reserves these pure-play companies have managed to raise absolutely prove that they possess the necessary financial fuel to cross the commercial finish line. The quantum era isn't a hypothetical future event. The foundation is actively being built right now.
The architecture of the future is being laid down block by block, and the public financial markets are offering us an unprecedented front-row seat to participate in that construction.
I want to leave you with a final, slightly chilling but completely fascinating thought to ponder on your own after this deep dive ends. Throughout all the extensive intelligence reports we analyzed, one terrifying theme kept surfacing in the margins, and that is cybersecurity.
It's a massive concern.
Quantum computers will soon possess the raw computational power to effortlessly shatter traditional encryption protocols. The complex passwords and highly secure servers protecting our global digital infrastructure today will be rendered completely obsolete in a matter of minutes. Within the highest levels of the cybersecurity world, there is a known and incredibly active threat right now referred to as hack now, decrypt later.
Bad actors, state-sponsored hackers, and criminal syndicates are currently stealing mountains of heavily encrypted data. They know they cannot read it yet, but they are patiently hoarding it on massive servers.
So think about this. If quantum computers will soon turn our current encryption into tissue paper, how much of your personal, highly sensitive financial and medical data sitting in secure cloud servers today has already been quietly harvested, just waiting in the dark for the exact day a quantum key can finally unlock it tomorrow?
It is a deeply sobering reality, and it is precisely why the global race for quantum dominance isn't just about corporate profits. It is fundamentally about maintaining global security in the 21st century.
It changes the entire perspective of why this technology matters. Thank you so much for joining us for this deep dive into the financial landscape of quantum computing stocks and ETFs. We absolutely love unpacking these incredibly complex topics with you, and we will catch you on the next one.